Roll call, please. Oh,
Sharif Mansuri
Here.
Paul
here.
Campbell, Pat Clark,
Here.
Aaron,
Here.
Dr. Shaker.
sorry,
Here.
Milt Wilkinson.
Wilkins, he's here. He's here too.
There's two of you.
You should be so lucky.
True, very true. Matt Livesey. Levon Singleton. All right, and we have Paul Bauer online with us today.
I'm glad. He's going to be the star of the show.
He's the only one.
All right. All the board members are here, so there's no issue on number 2, which is consideration of board member absence. Number 3, approval of the minutes from the June 23rd meeting.
Move to approve. Seconded.
All Sharif? All those in favor?
Aye.
Any opposed? Carried unanimously. All right, item number 4, request for benefits. First of all, the civilian request of which there appear to be
Second.
Usual circumstance.
No, please.
So for our civilian request, there was one person that was missed, back in May for administrative errors. So we have added them to our requests for May. So we have one, civilian returning for May and then 5 for, July.
Okay, thank you. What was the one?
It is
That has to be noted.
Cheryl Hodges.
That has to be noted.
Okay.
All righty. Police request for benefits.
Make a motion.
We need to vote on the civilian.
I move
Okay, fine.
Second.
for the.
We already moved in second.
Yes.
Yes.
We did.
All those in favor?
Aye.
Okay, carried unanimously. Number 2, the police request for retirement benefits.
Make a motion to approve.
Second.
Police benefits.
Any controversy there at all? Or
No.
anything? No? Okay. I may have a vote. All those in favor?
Aye.
Done. Okay. Unfortunately, the civilian request for death benefits. There are what? 1, 2, 3, 4, 5 people that. No, there are 4 people in 7 and 5 requests, I guess. 6 requests. In any event, civilian requests, as you have in front of you. Anything we need to know?
Move to approve.
You have a vote? All those in favor?
Aye.
Any opposed? And we have the police request, which is only one individual, according to my sheet here, going to two different beneficiaries, correct? All right. May I have a motion to approve?
Make a motion to approve.
Second.
All those in favor?
Aye.
All righty, that's done. Moving right along here. We usually have visitors. Are we sure that all the visitors have been accommodated and allowed to come up? Or? Guess they're all on vacation in the Bahamas or something.
Coming, she's.
All right. All right, Asset Consulting Group, that's you. Phineas.
Thank you.
James.
So I have a book in front of you. We will start with, really today, just, I know we covered, talked quite a bit about markets yesterday, going to expand upon that a little bit, a couple of dynamics that are going on. And then we'll hit our performance through June 30th. So halfway through 2026 already. And just as a reminder, next month, we will have, we call it final performance. This is pretty close to final, but we'll also have peer ranks for our plan versus other public entities as well as our managers. So we'll be circling back to these returns next month as well. But if you flip to page 5, in the first tab of our performance. So, again, just overall markets, really absolute returns continue to be strong. Of course, it has been a volatile year, particularly in the middle part. Just again, thinking back to, where we started the year, 2025 certainly was positive in the marketplace. Our portfolio was up about 14%. If we look at what happened this year, these are the major areas, at least equity and fixed income, where we're invested in our portfolio. And so coming off the 25, that's that first blue bar, the first 2 months of 26, very, very strong. Then what happened at the end of February, we know the Iran war started, really took a hit on markets, uncertainty, particularly around oil prices relating to inflation, how that's going to affect economic activity, et cetera. So saw a big pullback at the end of March, which really led the first quarter to be about flat overall. Second quarter is these green bars, which you can see really strong rebound. Markets overall positive in June, but really it was April and May saw this strong rebound. And so what you see here in the gold is returns to the various areas, certainly led by areas where we have exposure to. I would say even, and we'll see this next month as we look at versus our peers. We've talked about having a larger weight than most of our peers to emerging markets, to U.S. small cap. So certainly strong returns overall. I'll show you in a minute here. Our portfolio through the first 6 months of the year is up just over 9%, about 16% return over the past 12 months. So we'll talk about that. If you remember last month, talked about the strong returns that we've had, but also talked, certainly about, and we'll see this in our performance report, it's been pretty concentratedly left. The indexes have done very well, but the indexes, particularly U.S. large cap, emerging markets, even small cap to some degree, have become incredibly more concentrated. In other words, the bigger players in each area continue to get bigger. The rich keep getting richer. And a lot of this certainly has to do around the AI build out. We know a lot of these companies, CapEx, spending quite a bit. There is excitement there. So really leading to high valuations and really high performance, anything really in the AI tech ecosphere. So we talked about that last one. A few points I wanted to make out that's also been going on in this year. So equity markets done very well, been pretty concentrated. What are some other key dynamics? First and foremost, something we've talked about before too, dollar performance, and that's impact on the marketplace. What we've actually seen really over the last, probably since 2008, the US dollar has been incredibly strong, very highly valued relative to other currencies. 2025, we saw a little bit of a retrenchment in that, US dollar taking a hit, particularly as we went through some of that tariff dynamic. Well, really what we've seen coming back here in 26 is actually a rally in the US dollar, continuing to become a little bit stronger. Certainly a lot of this, as we can see, if you look at the top part of the page here, a lot of this does trend a little bit with our new Fed chair, Kevin Warsh's nomination, and ultimately the confidence that he has from the markets, at least having a focus and eye on bringing down inflation. And so what we've seen, what I kind of showed you here, gold and Bitcoin, not that we have direct exposure to either of those, but many times that's seen as an opposite investment with the US dollar, as replacements for US dollar from an investment standpoint. You can see returns, both of those having gone down, really kind of tracing back to Kevin Warsh's nomination. And on the right, maybe more importantly, is just that value of the US dollar, that appreciation which we've seen has moved up. Where this particularly falls or impacts our portfolio is with our international equity investments, right? So as a reminder, when we're U.S. investors, so we invest with dollars. So when we give it to whether it be Silchester, WCM, et cetera, they take our dollars, convert it to the local currency, buy stocks internationally, and then they value it. They got to convert it back to U.S. dollars. So as the U.S. dollar appreciates, that actually hurts the price that we're seeing in our portfolio. And that's what's shown here in the bottom of the page, which I think is a good indication. So I mentioned last year, 2025, the dollar actually fell relative to other currencies. So on the bottom right, you see what the S&P returns is, and you see that. But more importantly, if the MSCI ACWI ex-US, so international markets, if you were invested in those stocks in the local currency, your return was 24%. But if you were invested like we are through US dollars and conversion back, that return was high at 32%. So that was certainly a benefit to international investments in our portfolio last year. That's changed a little bit so far this year. You can see actually, if you were to invest in local currencies in international markets this year, you'd be about 16%. But when we convert it back to dollars, it's closer to 13.5%, 14%. So certainly an impact there. The other thing, so talked about equity market strong, high concentration, dollars rallied. The other continued theme we're seeing is interest rates continuing to remain elevated. That's even happened more so this morning. A lot of this certainly has to do with the recent Iran war, higher energy prices leading to higher inflation. And so what you see ultimately at the bottom of page 6, and I'll expand upon it maybe a little bit more on page 7, but also that dark blue line, that's the kind of what the Fed is expecting the Fed funds rate, the FOMC, to do. If you remember, everyone was pretty confident going back to January, February this year, the Fed was going to cut rates at least probably twice. Well, now the expectation is they're going to raise rates probably once, if not 2, 3 times. So ultimately, that is the expectation there. And again, that impact really has impacted not only shorter term interest rates, but certainly longer term interest rates. And that's what you see on the bottom of page 7 there. If you're looking at the lower right-hand graph, this is the U.S. is in light blue, and then we've showed other countries. And really, this is the change in the 10-year yield. So for us, that's the U.S. Treasury rate. And you can see right at kind of that start of the Iran war, certainly interest rates moved up across the board. This is something that particularly could have an impact on equity prices over time, right? Higher interest rates means it's more expensive to borrow. More expensive, certainly for us individually, is whether you're buying a car, buying a house, your credit card bills, but even more importantly for companies, as they're looking to do this CapEx spend, borrow money, issue debt, it's more expensive for them to pay it back. But also, certainly for us as fixed income investors, this actually becomes a benefit to us. Over the short term, there might be some hit in prices, but ultimately overall, the yield that you invest in is typically the return you get over time. This is why, and we'll look at our performance report, our fixed income returns continue to be higher over the last few years, over the past year, and we would expect that continue to happen with this higher rates that we're experiencing. So those kind of key themes going on in the marketplace. And again, we'll get to our actual performance here in a minute, but just page 8 again, certainly overall, our portfolio benefiting from this kind of certainly regime and higher returns. What you're seeing on page 8, this is kind of the rolling 10-year. So every bar is our 10-year performance, net of all fees. We include our policy index on here as well, but for each different time period. And so not surprisingly, just starting all the way back, obviously 2008 had a big impact and it lasted for a long time. As we've kind of moved forward, as that rolled off from a 10-year perspective, you see returns certainly got higher. A little bit dip. Remember 2022, certainly an impact on returns. That was the year the Fed raised rates 5%. We saw a big impact on portfolios. And you can see where we are here today, and we'll go through this in our performance report. But over the last 10 years, up over about 9.2%, again, net of fees over the last decade.
As I recall, 2022 was a disaster year for both equities and fixed income, domestically and internationally. There was no place to run and no place to hide. It's just a bad year all the way around.
Yeah, and a lot of that was led by certainly not only rise in interest rates, which we're seeing now, but as you kind of look at that graph that I've shown, rates are somewhat steadily moving up. In 2022, the Fed raised rates 5% in a very short period of time, right? The Fed funds rate was 25 basis points, and that kind of quickly went to about 5% in a very short period of time. So that was a lot of uncertainty for what I was explaining on the company standpoint. Saw equity prices fall, and certainly that big of a hit right away hurt bond prices as well. All right. So let's flip to our performance then. And I just talked about the market, so we can go on to page 11. So we talked about this last month. So now you see our portfolio up over $1 billion. This is a high watermark for our portfolio. Just to put a little bit in perspective, we were about $960 million when we started 2026. So that's an increase of about $75 million within the portfolio. And of course, keeping in mind, we're pulling out about $3 million a month for benefit payments. So certainly strong rally, strong appreciation in the marketplace. You look at our targets versus our current asset allocation versus our targets. We are in line with our ranges, with our investment policy statement. Not surprisingly, overweight equities, given how strong the run has been recently. This wasn't quite the case back in the beginning of the year. But again, we're still using this as a funding source from equities. We've again pulled out about already this year, almost $20 million from equities to pay our benefit payments. So continue to be in line with expectations. Page 12 is our actual performance. And again, excited to bring back next month. We'll have kind of the deeper dive as we look at our peer ranks, how we compare to other public plans and how our managers compare. But these are our returns as of 6/30. So at the very top line, again, our performance in that light blue box, net of all fees. So again, up over $1 billion right now. I'll point out the month of June, as you can see, slightly positive. Really, it was April and May with strong returns. So that 3-month, that last quarter, that was our return for the second quarter of this year, about 10.6%. You can see a little bit ahead of the policy index. And I'd also point out, you can see the last 3 months is actually higher than the last 6 months year to date, right? Year to date, we're up, like I said, just over 9%. This speaks to really that drastic pullback that we experienced in March, but then more than recovering from that throughout the rest of the second quarter. So year to date, up about 9.1%. Over the past 12 months, so since July 1st of last year, you can see we're up 16%. Last 3 years, just about 12% on an annualized basis. Looking down, versus our policy index, and I know we've talked a lot about this, you can see we are underperforming, certainly the last year in particular, 3 years, a lot of this going to, and we'll go through some of this now, really the concentration in the underlying indices. As a reminder, our policy index, this is our target asset allocation, invested passively in these passive indices that have become more concentrated and certainly more driven by AI tech exposure.
By the way, you ought to point out that emerging markets year to date was 28%. It's rather remarkable.
So emerging markets, so yeah, again, going back to,
Was that principally China or Korea?
what's that?
Was that principally China or Korea?
So both of them. So in particular, and part of this again, Taiwan within there as well, right? Really leading with that tech exposure that's really driving a lot of that performance. And not only, over the past year, right? Emerging markets, if you guys can hop all the way down, up 45%. So is small caps, U.S. small caps over the past year. Now, again, this is certainly a lot of concentrated AI tech exposure within there, but ultimately a big driver. And we've talked about, and we should see this in our peer groups next month, but relative to other public pension plans, they're much more concentrated in the U.S. large cap space. This is something that's hurt some of our relative performance as it relates to peers, but also our policy index. But now certainly we've seen this kind of rebound and paradigm shift, certainly to the benefit of this plan. And even you see that if you look kind of very top at that U.S. equity row, so our performance of U.S. equities, whether it's year to date, over the 1 year, you can see certainly, overall 12%, 23%, we're ahead of the Russell 3000. And yes, there's been outperformance, particularly from our U.S. small mid cap, underperformance from our large cap, which I'll talk more about in a minute. But really the driver of that outperformance in U.S. equity has been our allocation size to U.S. small cap and how strong it has performed.
I see most of the valuation numbers, quintile ratings on managers, etc., are not in this report. For any particular reason they've been skipped?
So that'll be in our quarter report. So the peer ranks.
So there is no relative performance numbers here as such.
No, on these monthly basis, we have our relative performance versus the respective indices. The peer ranks will be they come on a quarterly basis.
August. That is the historical pattern for them to assemble all the data and group it. So we get peer ranking 2 months after the end of the quarter.
Correct. So certainly again, Milt kind of hit on the big things, small cap in emerging markets, certainly leading the way. I talked a little bit about fixed income, interest rates. You can see down at the bottom. So over the past year, fixed income adding up about 4.5% to total return. Again, this is a number we've continued to see creep up particularly since 2022. If you remember before that, fixed income wasn't giving us much return, maybe 1-2% per year with where rates were, but ultimately higher, as well as, real estate. Real assets in our portfolio. This is an area we know real estate was challenged, particularly not only after COVID, they were hit with that change in how people are using, particularly office properties, but other properties. And then also the higher interest rates. Certainly a lot of borrowing within real estate. We think a lot of that medicine has been taken, and we're continuing to creep up to those higher expected returns that we think are going to happen. On our managers, so on the next page. So starting with large cap, and I talked about, and this is something we've experienced now for a little while. There has been underperformance in our active managers. So again, as a reminder, this is one of the spaces, at least right now, in our portfolio where we are predominantly passive. About 65% of our large cap exposures with Rumline, that's passively invested. So we're earning that return. But we do still have two active managers on the side of that, Aristotle and Jennison. And frankly, and actually was talking with Mill yesterday, I handed out a sheet that I can hit on here in a minute, particular to Aristotle, as they've had certainly some underperformance recently. But I would say both Jennison and Aristotle, the theme continues to be they own less of this tech-focused, certainly mega cap, that's the place they play in, exposure. Particularly whether it's either Russell 1000 growth or even the Russell 1000 value has become increasingly concentrated, a third or even more so on the growth side, exposure of the index in these top 7 Mag 7 names. And it's not that our managers don't have exposure to some of them, but they don't have as much exposure to all of them. And that's what's continued to hurt their performance. And like I said, I got a little bit more on Aristotle that I do want to hit on a minute. And really, it's been the last 2 years. It's not that the returns have been negative, but they have not been as high as the overall benchmark.
We are currently running 3.54% over our target allocation to equities.
Yes.
And why is that? Because of course performance, obviously, but other than that, why haven't we adjusted to our target allocation?
So, I mean, it's mainly been performance of equities. Also, if you remember, we put in some redemptions for real estate a couple of years ago. So
That should have nothing to do with why we are over allocated to equities at this point. What we are doing in real estate has nothing to do with this.
Well, it has to do with equities performance relative to real estate. So as equities have taken off and real estate has done better, but certainly not as high as the returns as equities, and we're also pulling money from that. That's led to some of the underweight within real estate. Also within there, we've been waiting a little bit, particularly as we're looking to have some, managers added to the portfolio on particularly the international equity side to really use that as an opportunity to.
But that would be adding to equities, not taking away from equities when we add the manager.
It would be reallocating within the equity portfolio, you're correct.
But that if we reallocate within equities, we'd still be over allocated. That math doesn't work. What I'm asking is, should we not be selling 3 to 4% of the equity to get to our target allocation, especially at these valuations?
There is, the policy is if in fact the allocation to any individual manager exceeds 20% of their target, but that target being at least 2 percentage points or 2 percentage points absolute, then that would trigger a rebalance from that manager. This may just be a point in time as opposed to a sustained thing.
But we are still waiting for the international indexed fund to be approved and allocated to. Right?
That is correct.
It's still not done.
Yeah.
But would it be prudent?
3.45% just may be a point in time, not.
Sure. Would it be prudent at this point to pull 4 or 5% from equities and park it short term into cash or equivalent till that approval is made?
It'd be easier, and I think prudent, to simply finance the withdrawal this month from equities, disproportionately finance it from equities.
The withdrawal for the fund. But
No, the withdrawal for the pension
To pay-
payments.
Make the payments, sell equities to make the payments.
well, whichever way we do it, I mean, I would be inclined to say that watch that over allocation with current valuations and let's talk about whichever way we do it.
Yeah.
We should be under and not over at this point, if anything.
Well, we've always had something of a difference opinion on that, but I agree with you. It should be closer to our target at the very least, right? But that is easily done since we have to take money out every month. Why it's 3.5% at the end of June, I don't know.
And that's what I'm asking. So, I mean, if we have extra for performance, that's when you rebalance and park some couple of percent in cash till the approval is done, and then we see the allocation at that point.
Well, it's, look on page 11. Phineas, why don't you walk us through your column there over and over?
Yeah, so that's our over and underweight. I think what Sharik is referencing. And so really big picture level, those gray rows, equity, fixed income, real assets. What he's talking about, so we're about 3.5% above our equity target. As you can see, we kind of have what's allowable in the range over to the right. So we're still within there. And what's driven most of that overweight recently has been the strong performance, right? I just talked about, real estate, fixed income, positive returns, call it 4-ish, 5-ish%. Equity certainly been double digit, been driving a lot of that. So
More specifically, it appears to me that emerging
It's emerging market.
is driving that
Correct,
over.
which we were opposed to allocating, to be in all fairness. But, we differed on that too. But now that we have the performance, I would say that we need to watch the exposure.
Yeah, well, I agree, and that over allocation now, as of the end of June, should be the first source we go to finance the withdrawal for pension payments in July.
And again, we're taking 3-ish million, sometimes more out of the portfolio each month. And so we're looking at this to pull from. I think, Sharik, you're asking, do we want to take 2% overall of the portfolio?
So let's do the math. 3.54% would be roughly about what, $23 million. Okay,
30 something million.
okay, and you're pulling 3 million a month, okay? You roughly need about a year to catch up with zero performance. Okay, so you're pulling $3 million ain't going to reallocate this thing. Simple math. So what I'm asking is, do we want to pull 20 million out and get closer to our allocation, which at these valuations, and what does that look like, and what do we need to do? Or we can say, no, we don't need to do it whatever the process is here. Simple question.
Yeah. And so I think it comes down to, if we were to pull money out, I wouldn't put it in cash. I would move it to our fixed income underweight, save for more stable.
And we underweight there, I'd be okay with that.
With there. So that's where I would do that. And I guess this is to the preference of the board. My thought, ACG's thought would be, listen, we are a pension plan. We need 7.5% over time. Over time, equities will add higher returns. I agree with you, equity markets have certainly ripped and valuations are higher. That's certainly, but in many ways, that's been the case for several years. And don't know what's going to happen over the next year. And given we're still within our ranges and using that monthly rebalance to pull some out, not all, as you mentioned, that in itself won't get us down to our target, but we're certainly comfortable being over target. But that said, or if the group feels comfortable or feels better that, no, listen, valuations are higher. We've had some great runs. Let's take some chips off the table. We certainly can do that. And I would recommend that go into the fixed income allocation.
Well, just do the rebalance sheet and send us a copy so we understand exactly what you plan to do. Just that simple.
Certainly I can send a rebalance sheet, bring that back, kind of what we want to do if we were to
We're doing something this month. Has money already gone out of the pension plan this month? I wouldn't think so. It goes out at the end of the month.
Yeah.
Send us the rebalance sheet so it can answer Sharik's question. There has to be a rebalance sheet. Somebody between you and the county staff, you develop this stuff every month. So send us all the rebalance sheet so we understand specifically what you plan to do. And then we can say, is that sufficient or insufficient or whatever,
Okay.
which not only the rebalance sheet would not only cover the withdrawals, but also brings other things. We need to add to fixed income, we add to fixed income. We're not adding to real estate, that's for sure.
No, we're not adding real estate. I guess so we'll send the rebalance sheet, what we're gonna pull out this month, we can do that. The question, so we're not recommending at the moment that we take more from that and add to fixed income. It's certainly on the table and we can. And I can run if we were to do that, I can run the rebalance sheet of what that money would be and where it would go.
What I'm asking for, send to us your plan, your recommendation for rebalancing.
Okay.
And then we're all talking about something specific and on the same page, right? That should take a day.
Yes. No, we do that on a
Some
monthly basis.
things where it's too late to take money out of certain vehicles because you have to give them notice by the 15th of the month. And so the rebalance would take place a little bit later,
Mhm.
but send us a plan for it.
Yep. We can certainly do that. Okay. So again, I'll circle back to a little bit specifically on Aristotle. Within small cap, certainly this, again, an area that's also run up like emerging markets over the past year. Ernest, Granite One, who we know, Granite actually were in process of looking at a passive option, but you can see in the interim, they're still in the portfolio.
Yeah.
Performance certainly participating a little bit more so far this year to date. International markets, Silchester, WCM, William Blair. While you can see certainly on the growth side, WCM, William Blair performing well so far year to date. Last year, I mean, I know we talked about this, certainly a very tough environment for them. Similar dynamics on the international markets, particularly the fourth quarter of last year. Somewhat concentration, but mostly more unprofitable tech-focused companies really driving the way that neither of these managers, certainly owned. Acadian within emerging markets, this will be and continues to be an area that we will continue to take some chips off the table. Their performance is the top of 14. You can see been very strong performer for us on a relative basis, but certainly very strong absolute returns over the past year. An area certainly we're overweight are because of this in our portfolio right now, but also, we've had a dedicated allocation to this, probably more so than our peers over the last few years. And this is something that certainly benefited our portfolio. I talked about fixed income, certainly the higher returns we're seeing, IRNM, our core manager. But as you get into Janus, Pioneer, who were able to invest in some of those higher yielding securities, even adding a little bit more outperformance. And then our real estate managers, which again, we reduced overall our target about a year or two ago, and have asked for some redemptions from some of them to fund other areas. But you can ultimately see some of that performance, at least from the asset class level, and also each of these three managers coming back.
Well, in real estate, the target allocation is still 10%, and we're essentially at 9%.
Yes. And we were at 15, if you remember from the
I
target
remember
perspective.
very well.
Yeah.
Recall, I was a person who recommended 15 back in 2017, 18, something around there. Okay. It was very profitable for a long period of time, and then all of a sudden, COVID hit first, and that was a major thing. But there's been a dramatic shift in what sectors of the real estate universe are successful right now.
Multifamily is doing very well. It's been done
Yeah.
very well. It's the office space that got hit.
Office space.
Warehousing is doing extremely well.
That was what I was
Almost
saying.
sectors. So the only one portion of real estate got hit. So I don't know. I asked before what the percentages are and whatever, but we never got that breakup on our managers.
No, we did. It's in our quarterly report. We can show you again next month.
Okay.
Bebe, do you have a question?
Well, and maybe we'll talk about this next month, but I mean, just looking And I know large cap active managers have had a difficult time, but just looking at Aristotle, they're
Yeah.
they're so far off.
Right, do you have something to say about this?
I do, yeah, so I have a little more in Aristotle Pepe for
Over the
sure.
last 5 years. I mean,
Certainly, and I brought some more information, but I think bigger picture, particularly as we talk about large cap, right? I mean, this area from an index perspective has been more, when I say concentrated, right? The index has been really driven by a
Names,
handful of names. And so really our
Well,
decision point is, as we talk about this and what we want to do is first and foremost, do we want to just get out of the active and go passive in this space, right? I mean, that's question number one. I mean, with this group and we've talked about is keep in mind, do the math here, but it's 65% of this portfolio is passive. And the thought of the two active managers is to invest differently from that. Over time to add value, right? Of course. But to invest differently from that, which
One
really
second.
means
How is 65 passive? Rumline is 15,
Of
no,
the large cap
of the large cap.
equity.
of the large cap, within large cap. Okay.
Yeah.
Okay.
So, yeah. And
So it's 17 otherwise.
yeah. And so this, in most asset classes, but certainly within large cap, right? All active managers have struggled. We kind of showed some of these numbers last month.
This, however, this is large cap value,
Mhm.
and Aristotle wasn't a problem up until about 24 months ago, I think. This is large cap value. That's not really affected by the Magnificent Seven.
Well, no, there certainly are those exposures within the index, and those have continued to
Large
do
cap,
quite.
which company is in the large cap value index? Which of those companies?
Could we get a holding list for Aristotle?
Sure.
Could you just
Yeah.
email that out, the full holding list
We can do that.
with percentages up to at least, all of them or the major ones, whichever way, major at least 20.
Of the 7 companies which drove the market, in theory, the overall S&P 500, none of those are, I think, a large cap value.
Yeah, but I mean,
So I'm wondering,
if
why is Aristotle so far? You can't say Aristotle's behind because it doesn't hold those names, because it never would hold those names, and the index shouldn't hold those names. So why is Aristotle behind? And you wanted
But if let's look at the holding list, and maybe this is time
That's
to
more-
allocate 1% or 2% more to them. Maybe we give them another percent.
Yeah.
Because
think-
value will at some point will
I think your
reverse.
suggestion is the right suggestion.
Yeah, so we take
And-
off from somewhere and we maybe add to Aristotle at this point would be, if it's a solid holding list, let's take a look at it and see what conclusion we come to.
Yeah, and also, and I'll get the benchmark names in there as well. I mean, maybe not all the ones all the way down, but the larger weights within the index as well, because there are some of the Mag 7 in there. They're different weights than would be in the Russell 1000 or growth for sure. But there's certainly some of those names who have done very well. But I think Pepe, to your point, so this printed out sheet that I handed out with the book is just some really performance data looked at a different way for Aristotle. And really what you'll see is over time, Aristotle has been a very strong performer. As Milt mentioned, it's really been the last 2 years where they have really, they haven't lost money, but they've fallen behind certainly the
the
index.
index, yeah.
And a little bit of this timing with our investment. So if you have this one page stapled, I don't need to go through all of it, but so the first is page number 3 in the staple.
Page 3.
In the stapled
It's
copy.
in this, I think it's this.
We have
It should have been under your book.
Yeah.
Hand it down under your book, if not.
Okay,
Anybody?
okay, got page 3.
Yes, page 3. So this is our time with Aristotle. So we hired them back in 2020. And you can look at the lighter, and I wish I had better colors here. The lighter color is growth of $1, basically. Over time, what our investment return is, if you would invested $1, what it would have been with Aristotle and what it would have been with the index and darker blue, the Russell 1000 value. So you can see certainly over time, at different points, we've been ahead with Aristotle. That started to fall off, particularly kind of beginning of last year. And you can see that divergence has come much more recently. The next page, page 4, is that same theory, growth of $1. But this is since Aristotle's inception, which was back in the early 2000s.
Mhm.
So since the start of the strategy, again, if you would put $1 in that then versus $1 in the index over that time, where you would be. So Aristotle has done quite well over time. And really what's driven it is page 5. So so it's rolling 1-year periods as of the end of June 30th. So that first kind of top June 2026, this is the 1 year of the index above it, the 1 year of Aristotle below. Red doesn't mean it's a negative return. Red means it's underperformed the index over that time period. So it's really been the last 24 months when you look at it through this framework. First off, a year ago, down by about 6%. Over that 12-month period, and then this 1 year, about 7.8.
Mhm.
And so again, from Aristotle actually just in our office, and we'll follow up with the holdings list, but frankly, whether it's semiconductor types of companies, they just think, first off, there's not really a moat around those businesses. They're easy to compete with, and also the valuations just aren't worth their investment, and that's what's held them back. As you look at kind of longer term over the years, you can see Aristotle certainly has been pretty strong performer. Certainly much more years higher than the index. Even the other years where they underperform, it's in red. It's typically not by that much, but it's also followed by years where some pretty strong outperformance. And so really, Pepe, your question is great. You look at our performance report, and it's hard not to notice it jumps out. And what jumps out really is the byproduct of really the last 24 months.
And particularly, I think, over the last 12 months. I'll give you one example. And this is why the list of companies would be very important. I appreciate your suggestion very much. But Micron Technology, it's always been a bag of stocks, a PE of somewhere around 6 or 7. Well, this year, Micron being large cap value, through yesterday was up 214%.
No, actually, it's gone up 10 times. Micron's up 10
I'm talking
times.
about this month, this year,
Okay.
200. So if they were under allocated to companies or actually allocated properly, companies in the index, which are computer memory related, they were under allocated. They would fall behind dramatically.
Yeah, and then Micron
Micron,
for
Sandisk,
sure is a
Seagate,
decent underweight in their portfolio.
Seagate, all those. So it is important that they or you give us an idea of how that mix of how their portfolio mix has differed from the index.
Also, if
And
you
then
can.
that gives
Go
us
ahead.
some insight as is there a problem here, or is simply the dynamics of the market have shifted so dramatically that it left everybody behind.
Also, detailed valuation metrics on the portfolio would be helpful.
They do have that in their
So holdings plus the metrics, and I think that's where you add value. If that's solid, I mean, you add some money at this point to value that has not been moving. At some point, it reverses, just like international. I think maybe next year, maybe 2 months from now, who knows? Nobody knows. But I think this is where it's a solid portfolio. We put some there and take some from growth or international or wherever. See what the rebalancing makes sense.
Yeah, I think it's good.
That's
Sorry,
it.
cut you off.
That's it.
No, I agree. We'll bring back that holdings list. We have the valuation metrics we'll have next month.
Do we
all
have to
those-
wait till one month? Do we have to wait one?
I beg your pardon?
Do we have to wait a month for the next meeting to do that, or can we do it?
No, I can send it to you.
We have to, it has to be a formal meeting for us to talk about it, but they can send it out.
But I can send it out.
We can just instruct.
Hmm?
Between meetings, we can't instruct for the rebalancing without a meeting.
The rebalancing is an operational item. That does not require a meeting.
That's all that.
Public notice. That's an operational item.
Okay. We'll take it from there.
So, and we can continue to go through this, but ultimately, I mean, the point is, we've kind of put other rolling returns and ranks of Aristotle within there. And again, I think it's a great point. Let's look at their holding space, but ultimately, while, Pepe, your question, you look at their performance kind of as it sits June 30th to 26, certainly some underperformance, but Aristotle frankly has shown to be a pretty quality manager who's added quite a bit of returns over time, whether it's on the rolling 1 year, the rolling 3 years, the rolling 5 years.
Based on the numbers, it appears that up to April of 2025, it ran pretty much in concert with their underlying index.
Mhm.
From April of 25, they've been going like that.
Yeah.
So it'd be interesting to understand the evolution of that portfolio. Not that we're going to be portfolio managers here, but we want to understand why what has historically been certainly an acceptable manager. All of a sudden, it's like the numbers are grossly unacceptable.
Yeah, it is, and maybe the last thing I'd point out, because I always like this chart, is page 9. You look at rolling performance. We've got a lot of showing you rolling performance. This is similar thing, but it's actually rolling ranks. So how Aristotle compares to other large cap value managers over the space. And the chart's kind of maybe a little bit confusing. The gray bars you see over time is actually the return of the index. So at periods where it's high and low. But this is a rolling 5-year rank. That's what that light blue line is. So you kind of move your finger across that line, and over the points in time on the bottom, that's what their 5-year peer rank is. Again, kind of 1 being the best, 100 being the worst, as we're used to seeing. And that green line is the average of all. Right. So certainly on average, their 5-year peer rank is top quartile, but that certainly has not been the case, really, particularly of recently. And again, a lot of it having to do with those last few years and inbuilt, as you were mentioning, that separation.
Right. Well, you bring back the
Yep.
more detailed analysis next meeting.
And we'll send it out ahead of time. That holdings, at least the top part of it.
Send it out as soon as it can be completed.
Mhm.
Okay, and then
Yep.
we'll decide what we do at that point.
Yep.
I do think, Penny, that it was helpful, page 3 and 4, where it gives you the perspective over the last 25 years, because to your point, this is a pension plan that's going to go on for a very long time. And so we can't, 2 years of performance over the lifespan of the plan doesn't necessarily, I don't think, equate to immediate action versus having a longer frame of reference over multiple phases in the market of how a manager has performed. So I think this was helpful.
Okay. Well, thanks for the questions, and I'll follow up with those as soon.
Anything else, Phineas?
That's it for me today.
Any other questions, or for Phineas concerning the ACG report? Okay, fine. We're gonna go on to item number 6 now, and that's the COLA. As we committed some time ago. I think, Joyce, you were the person who actually asked for it, but as we committed some time ago. We have to have a specific official vote on whether to recommend to the county executive to implement a COLA. If so, what are the criteria that we're using to make that recommendation? And what is the amount of the COLA that's recommended? And so now we have to have an official vote. Would anybody, and we've talked about the funded ratio of the plan at the last 2 meetings. Several years ago, the board, when we did our first 2 COLAs in many, many years, what was that? Marion, it had been what, at least 15 years since? Several years ago, in 2021. Yeah, we implemented our first COLA. And we had board at that time at mid-year, about this time, adopted three criteria we should look at when considering whether or not it was both reasonable and prudent to recommend a COLA to the county executive. One was that the funded ratio of the plan on a market value basis, not an actuarial basis, but a market value basis, was at least 80%. Two, to put a budgetary number around that, the COLA can, if recommended, could not exceed 2 percentage points of funded ratio. In other words, it may be 80% when you to say yes to a recommendation, and we're allowing it to go down as far as 78% on a pro forma basis after the COLA would be granted. And then there was the third criteria, which is more judgmental, because our overall objective at that time was to drive the funded ratio up to 90%. And so it was judgmental as to whether or not that COLA would materially negatively impact our ability to achieve 90% funded ratio over the next several years. All right, those are the three criteria that we adopted in 2021. Now, the first question we as a board have to decide is whether or not those three criteria remain reasonable. Or should we add or delete any of those criteria, modify any of those criteria? And then we would decide as whether or not to recommend to the county executive to consider a COLA. A COLA goes to the county executive and then it goes to the county council. Now, the board did recommend, this was after some of you may not remember this, but I was chair for a long period of time. And then I voluntarily gave up the chair to Jim Kinane, who I brought onto the board. Jim and Brian Hansen, and then Brian, I forgot the guy's name already, but I brought Jim and Brian onto the board. Jim was chair. Under Jim's leadership, the board did recommend another COLA, because the first two COLAs were first COLA to try to have some meaningful impact on individuals and retirees, was for people who had been retired at least 10 years on. The second COLA was focused on people who had been retired for 5 years to 10. Jim, and under his leadership, the board actually recommended a COLA for people who had been retired for less than that 5-year period. That recommendation was very poorly received by the county executive. Very poorly received. Eventually, Jim left the board because of it's not a matter of leaving the board. That's $100 a month. It's like going to Red Lobster for 2 or something of the sort. That doesn't make any difference. But it was very poorly received. So whatever we decide to do, yay or nay, we have to have criteria that we believe are appropriate and prudent. So, any comment on the three criteria that I mentioned? Should there be a fourth? Should be a modified 3, modified 3rd, or should there be less? How does the board feel about a minimum of 80% funded ratio on a market value basis as one of the criteria? I will say that as I had our prior actuary look at this some years ago, for those plans managed or supervised by the state of Missouri, and we're not supervised by the state of Missouri, but those plans in Missouri, public plans, are supervised by the state of Missouri. The state of Missouri, coincidentally, didn't know this at the time that I suggested 80%. The state of Missouri had adopted 80% minimum funded ratio for those plans to consider implementing a COLA, assuming a COLA was discretionary, like ours is discretionary. If it's dictated, if it's already in the regs, that there will be a COLA every year tied to the cost of living index or something like that, that's different. But for those plans that have discretion over whether to grant a COLA, 80% turned out to be the number that they used. And I was really surprised at that, but that's the way it was. But coming back to our situation per se, does everybody still agree with the 80% minimum threshold?
So
Question that I have is, we have a civilian plan, we have a police plan.
Yeah.
The 80% applies as the aggregate of the two, not,
That's correct, the aggregate of the two, because there's only one plan, it just happens to be separate books. And in fact, the civilian plan, as Marion knows, is actually approaching 80% the last time around. But the police plan is way below that.
Right.
Below 70%, as I recall. And the only way I can rationalize, not rationalize, don't rationalize, but think through it, is that the county executive has been so aggressive in giving salary increases to the police force to both attract and retain good officers. That was necessary. In Dr. Page's opinion, that was certainly necessary. And therefore our pension contribution has always been less than what actually turned out to be the necessary to keep up with the salary increases in the plan.
So you're correct, when there is a salary increase, the benefits have to increase in proportion. So when you get that salary boost, your gap of the unfunded, excuse me, percentage, will go up naturally and maybe catch up. It's a little bit of an immediate gap, because I think that was done last year, I think is what he said.
Well, the
Major-
salary
yeah,
was,
yeah.
but not the COLA.
Yeah, that's what I'm saying.
So, number of years ago, Mr. Stinger was county executive before he went off to other, well, I'm not gonna ask questions, embarrassing. But before he was dismissed from the county, I made a recommendation to Steve Stinger that the county make a lump sum, one-time contribution to the police component of the plan of $5 million. And that would have brought the police component and the civilian component more in line with one another, not exactly the same funded ratio, but something we thought could work very well. And then we press on from there. But Mr. Stinger's office said, no go, they don't have the money. So that was a number of years ago. So coming back to the 80% on a market value basis, is everybody still comfortable with that? And the thinking also is, on a market value basis, we would reach 80% before we would on an actuarial basis. And if you look at the state of Missouri guidelines, theirs is on an actuarial basis.
We're currently at 72.5% today,
Overall,
as of December 31st.
does everybody support that as a reasonable approach?
Yeah.
Okay,
I'm comfortable with it because you're talking about market valuation, which at the moment is really good. But that could go away.
it could. Either way, as the markets go up or markets go down, whether you're
Right.
talking about actuarial or market value, the numbers will go up, but not at the same velocity.
Right,
Actuarial will be slower
right.
to go up and slower to come down. But nevertheless, still under 80%. So therefore, we can't do anything. All right, then, I'm sorry, Aaron.
Do we think it would be beneficial to have these COLA discussions? Well, when is the actuary report usually released? It was early. this year.
Momentarily. As soon as we tell him, release from us to the county, to the county executive, or release within the county.
The actuary report that we got from Paul, when was that released this year?
Paul, when do you plan to release the report, or when is the report scheduled to be released, I should say?
Well, you all talked about it 2 months ago, right? So I think it was released in April.
yeah.
For you all to consider.
No,
No, that's-
Aaron is talking about officially. Has it been officially been released to the county council and for public consumption?
I would have no idea. That's a staff question.
Did you vote on it in April or May? Sorry, I wasn't here.
Well, we have voted to accept the report.
Okay, then it's done.
It's done. Okay. Now, what one can always do, of course, let's say hypothetically, the plan was under 80% as of December 31st, 2025. But the market went gangbusters. And by June 30th of 2026, we're at 79 to 80%. We have the discretion to say, since it's that close, we believe it is reasonable to consider implementing or recommending a cost of living allowance. Now, we did that in 2022. And for the first half of 2022, things were just wonderful. In the second half of 2022, it was like the Titanic with extra water. And so we do have that discretion if by mid-year, things have changed so dramatically that we would consider something, consider a COLA, even though the funded ratio as of December 31st was below 80%. So what I'm asking for is a board continued endorsement for the 80% as well as the 2 percentage point maximum as the budgetary number. Whatever that dollar amount would be, it would result in no more than a 2 percentage point reduction in the funded ratio. Is that clear? In other words, it could go down from 80 to 78, and that would be acceptable as long as it started at 80.
You're saying after the COLA would be implemented?
That's correct.
Okay.
That would be the budget for the COLA.
Okay.
So it would not be further discussion. That would be the budget for it, no more than the
2%
dollar
impact.
amount that would impact the funded ratio by 2 percentage points. And our actuary can run those numbers as well. So is there any further discussion? Well, if there is no further discussion, would the board entertain a motion, or I would entertain a motion as to whether to recommend or to not recommend a COLA at this time?
I would move to not recommend a COLA at this time.
You make that as a motion?
Yes.
Can I have a second?
Second.
It's been moved and seconded that at this point, in view of the funded, principally in view of the funded ratio being at a level substantially below the 80% on a market value basis, that the board believes that it would not be prudent to recommend a COLA at this time. All those in favor, say aye.
Aye.
All those opposed,
Aye. Nay.
nay. 1 nay and 5 ayes.
Do a roll call. Just
Let's do a roll call to make it complete.
Aye.
Roll call. Pepe.
Nay.
And Schaefer. Paul.
Aye.
No. Sorry.
Aye.
You've got.
All right.
Scott. Sorry, I was looking at you two both like county people. I'm
Right.
sorry.
Aye.
Thank you,
I'm
Scott.
the no vote here.
I think that's a prudent thing to do, and hopefully it won't last much longer. But the county, I don't think it would be prudent for us to recommend it, having fiduciary responsibility to the plan. And I'm almost certain that the county wouldn't accept it. But whether or not they would accept it is a totally different issue. We just want to live up to our fiduciary responsibility to the plan. If we thought from a fiduciary perspective, we should do it, we should recommend it regardless of what the county council and the county executive finally decide to do. Okay? All right, next item. Implementation status of previously approved new investment managers. Status?
We completed our initial review and the contracts and forms. We moved to the administration department. That was our understanding of the process. So the forms now, it looked like, were those complete? I just got, okay.
So there were two. One dealt with Granite, the other dealt with Sanderson. Where we're gonna, on Sanderson, we're gonna split it between Sanderson and I think it's a BlackRock.
Northern
Pastor
Trust is.
Yes.
I'm sorry?
So Northern Trust.
Northern, I'm sorry. Well, no, I'm talking about the Sanderson one.
Silchester.
Silchester, I'm sorry, quite right, Silchester, Sanderson's long gone now. Silchester, that was one, and then the Granite one dealing with the Northern Trust 2,500. Is that correct?
We've got the two that are pending, the portfolio advisor is just, that was completed, so that
that's-
one's done.
That's routine.
That's done. Milton, I don't think the Northern Trust has gone to the county council and county executive.
Yeah, we do, we have legislation to proceed, I think.
Those are done.
Yeah. So now we're waiting for feedback on the comments we made to the underlying contracts for the two, the BlackRock and the Northern Trust.
Were they approved by the county council?
As an investment agent, I believe, yeah,
Northern Trust was approved
and
by the county council,
and BlackRock,
and BlackRock were both approved by the county council.
right?
Fine, so now we're just trying to tie up loose ends on the contract
Correct.
itself, contract language, etc. Will you inform us when that is done? I presume it won't take much longer.
Sure.
About 8 months is probably sufficient, but 7 months. All righty. Other business? Other items you want to cover? Is there anything you particularly want to add to, suggest for the agenda at our next meeting? Obviously, ACG will do their customary analysis, which we have peer rankings on it, manager as well as for the portfolio overall. Is there anything else?
I mean, just a comment, this should serve as a reminder of how our hands are tied when it takes 10 months or 8 months to do a simple approval like that. Which is why I was advocating some kind of an allocation fund that we were never, ever able to, for whatever reason, I think that needs to be revisited. We can talk about it. But I think that this is the exact reason why this pension plan needs an allocation of somebody else at a fund level, a professional who does that or a team that does that. Because we are handicapped and we need to realize that we are handicapped in doing, even if we could do it, even if we were the smartest people and we could do it, we are handicapped in doing that. And for that reason, please, everyone, ACG at your end, we at our end, please do our part to find an allocation fund where we can put 10, 15%. So a professional team can make the decisions in this dynamic world, because we sure as hell cannot, period. We cannot. And that's a disadvantage to this fund and a disservice to this fund. I know I've said this before and I sound like a broken record, but I'm sorry. I think this is a very good reminder of exactly that happening here.
So are you asking for something to be presented at the next meeting?
I've already asked, we've never been able to find a vehicle. For what reason, I do not know. There are hundreds of them out there that are low cost allocation, and it can be done through 3. Maybe it's not 1, maybe it's 3. One's with the different cap, the international, whatever, global allocator. I know there are tons of them out there, and we take a big name, so we don't have an issue. It can be the PIMCOs, it can be the it can be the Templetons, it can be the BlackRocks, it can be whoever, take a big name and do it at the ETF level where, or some structure where it is not at 100 bips. We were presented a couple of options at 100 bips or north of it or close to it. And I don't think that's necessary to go to 100 bips to do that.
Denise, you have anything?
No, so we brought back some active global allocation managers, some that just do equity, some that do the broader portfolio, kind of fixed income inclusion. They are somewhere between, 50, 100 basis points for an active component on it. We found some more passive implementations, a Vanguard, for instance, or others, that you can certainly do cheaper, but they tend to just have a target asset allocation weight and stick to that. So it's not a tactical implementation.
And I think that's okay. I think at a passive level, somebody who says, let's take 2% from the US market, put it international, or take 2% from international, 3% to the US without having an 8-month wait is value added. And quite frankly, look at our record. I mean, passive is the one that's outperforming active anyway. So if that component comes at 15 or 20 bips or something like that, and it's passive, I think that's totally acceptable to me. If that's the only downside to it, because I mean, we are saying that there is a place for passive investment. So why can't that sleeve be passive? I don't think that's an issue.
Well, I mean, so the underlying sleeves are passive, but also they take a pretty passive, if not totally passive approach to sticking with their target allocation. So there won't be much
Active reallocation
Right.
going on. I mean, we could do research. I just feel like that's not our area to do research and provide you with funds to say, hey, listen, how about this or how about that? And
Nevertheless,
and
I would really appreciate it if you would suggest 3 that we look at. Nevertheless, that's why we're here. Bring our collective
I
wisdom.
don't think I'm comfortable with that, because then that comes back to me. But, you know, I think the idea as a whole should be accepted, and then it's ACG's job to provide us the proper vehicles for that. It is not our job. And so,
Yeah, I understand what you're saying. And you may have other considerations, professional or personal. But if I knew of a outstanding manager that I had personal experience with, that this board ought to consider for whatever the mandate might be, emerging markets or small cap, I wouldn't hesitate to recommend that ACG look at that specific.
how about we
manager.
do this? How about ACG comes up with 10 names of large companies such as Vanguard, such as PIMCOs, such as that have a allocation fund, and they do that fund of funds or an allocation funds, whichever way you want to do it. So you can do an envelope of fund of funds if it's not the preferred fee wise, but if a fund of funds for 15 bips or 20 bips with underlying ETF executes at 30 bips total or 35 total, you know, something like that would be doable. But give us 10 names of the large companies that do the fund of funds or allocation, and then we will go through our due diligence to maybe select 1 or 2 of them and fit that bill. How's that? And if we come up with a couple of names, we'll add to that list. But I'd like the brunt of the work being done at ACG rather than on this side and the ball being left on our side.
So certainly do that, bring that back.
Don't bring the 100 basis points, 120 basis points options. Don't even bring it, because if we are going into a market that is going to have subpar performance, then paying 1% for fees is going to be, I don't think that's going to be the right thing to do. So I think we have to watch the fees and at the same time achieve in a not so perfect world, maybe 70% of what we want through one of those funds. But the 70% is still better than waiting 8 months for a simple index allocation approval.
Is there a fee ceiling in this exercise you'd like me to stay under?
What's reasonable? 35, 40 bips max?
Yeah, I mean, so there's options along there. I'm just saying what I'm hearing, Sharik, is we want someone who can take that decisions for us to kind of be tactical and move stuff around. And what I'm saying is the more tactical an implementation is, the higher the fee will be, is what we found. And so we can certainly, I can hone in on, and we'll hone in. We brought some of these, we can bring some more who are on the lower cost side. But I do think they will be more of just stable allocation, broad diversification indices than the tactical moving.
So, I mean, my answer to that would be if somebody has a real track record, right? Like, I mean, if you look at hedge funds and stuff, they're running at much higher than that, right?
Mhm.
But I
We had a
mean,
chance to go with David Tepper, it'd be nice.
but I mean, if there is a reasoning in performance, not 1 year or not 2 years or 3 years, if there's consistent overperformance by that company or organization, then I think it can be looked at. But at least me, I would be more inclined to choose a low cost option than to say, oh yeah, sure, we're going to pay 130 bits for this and then be disappointed. If there's a solid case that you can bring, I mean, if you're going to bring green light capital or something in it for like, 200 bips or something, and I mean, you can. So I mean, if you can do that, then fine, we'll look at it. I'm not saying no, but I mean, unless you can bring the likes of those kind of hedge funds or other alternatives, if it's just a simple allocation fund from BlackRock and it's charging 150 bips, I say no, because we can do that through ETFs and a fund of funds and do it at 35 of bips all day long. Why would we do that? But if it's a known team housed somewhere, and you say, hey, listen, this is what it can achieve for us in this environment. I'm not saying we're not saying no, but we're saying the odds are low that we will say yes to a high fee, alternative. Is that fair?
Yeah, so I think we'll zero in on those, lower fee paying options and see what's available.
And maybe it's a combination. Maybe we throw 3% at something or 4% at something. It's not going to be a 15% allocation to one of those things, but can it be a 3% allocation? Okay. I can start it. I mean, we
We've had
can.
fund of hedge funds in here before, the speeds are high.
Yep.
Yeah, I want to bring one of those. So we can certainly do that. And then I'd also,
Excuse me, I just want to read out, at one time, we did experiment with fund of hedge funds. We had 2 of them. And the whole idea was to get equity-like returns with substantially lower standard
It doesn't
deviation.
happen.
Here, the mission would be somewhat different, but the principle is still the same. We can entertain a fee structure which might appear to be high, but is more than justified by the benefits. So the risk-benefit trade-off is very compelling.
Well, there are 2 issues. First, you can't do just one hedge fund. And the second issue is everybody's dog has a hedge fund right now. So, I mean, you've got to be big enough and allocate enough to get to the good ones and not just a hedge fund.
That's correct. I wasn't suggesting that we do hedge funds.
Yeah,
What I was suggesting is that we've entertained higher margin,
right.
higher.
And I don't think
fees.
we have the
for
depth
the-
in this board to select hedge funds at this point. So I'd say forget it. That's the other thing.
Again, I wasn't suggesting a hedge fund. I was talking about, we've adopted other vehicles which have high fee structures because we thought the fee structure would allow us to complete the mission. And one of them worked out very well, and then the other did not. Okay. You know what to do. You know what the request is.
I do, thank you.
All right. Is there anything else? Open to questions or comments from visitors, of which we have at least 2.
Yes, on the issue of the COLA, I think it's not appropriate to deal with what the funded strength was 7 months ago as of December 31st. That's a figure that is not current and it's out of date. Today's figure is different. If you look at Phineas's report on page 16, it shows the funded strength today is 81%. Last month's report that he submitted also showed is 81%. So why are you talking about making a decision on 7-month-old data? That's not the correct data.
It's, Paul, as I recall, our conversation on this, even though the market value would be as of June 30th, 2026, the liabilities would not be of June 30th, 2026. Is that correct?
Well, I can't speak to what Finney has in his report, but I would assume he's being consistent. I don't know what's driving the 81%. Can I keep talking, Milt? Is that okay?
Yeah, please.
So Finney actually shared with me the June 30 numbers earlier this week, I think, Finney. And I actually projected our evaluation results from January 1 to the end of June and came up with an updated funded status of 77.1%. So again, I don't know what the 81% that's in the report we're talking about, but from an actuarial perspective, the market value funded status as of June 30th is 77%.
The liabilities are based upon what date?
June 30th.
Liabilities have been updated, in other words, right?
Yes.
Okay, good. I just want to make certain we were comparing apples to apples.
Yes,
And
sir.
Paul, that's the two plans average together, right? I'm sure it is, but just.
That is
confirm.
the composite plan. Yes. I did not look at things separately.
Okay. And to answer your question, Paul's the marker here in terms of the actuarial report.
Absolutely.
Yeah, I mean, it's not gonna be ACG. I mean, if ACG comes up with,
I don't know how you can resolve the difference, you know.
There is no
You have
difference.
one figure and
That-
he
that-
has another.
why do you even have a figure? Why do you even have a figure? Because you're not doing the evaluation.
No, we're not. So this is a legacy scorecard that the prior consultant before ACG took over was doing, and so we just kind of.
I think you should take it out. It's confusing. It's not your job to do the funded status.
I was going to suggest the same thing.
And the evaluation carries no weight from you guys because you.
No, this was just kind of meant as previously, I guess.
I
as
know.
a
I'd
quick
say
look.
take it out. That's our official.
I was going to say the same thing, but whenever we talk about funded status, we ought to make certain we're not only talking about the market value of a certain date, we're talking about liabilities of the same date.
Right.
Because I've seen past people present a funded status and they're using current market value, but the liability numbers as of the current 6 months. So that has to be done. But why don't we just take it out because it's going to be confusing and it prompts questions like that. Now, what we can also ask, it's going to be more work on Paul. But we can also ask Paul to do is not only provide us with the market value funded ratio as of December 31st, 2025, but as of June 30th, 2026, as an example. So we're looking at more current data. We did this in 2022. That was for the second COLA.
I'd like to see just a handout from Paul that has that data on it. If you're going to consider his data for today's meeting to make your decision on, then that should be in writing somewhere. So everyone, including me, has an opportunity to have access to
Well, we weren't, that's why it isn't here.
these
We
transparent.
weren't going to do it that way. But that's why it's not there because we were not going to move to that level. 77% just isn't enough.
Yeah, but no one knew the 77% until 2 minutes ago.
And most plants don't even go mid-year before they look at their, they look at an annual basis, not on a year basis.
Then something January 1, you've got to start months ahead to get it through the whole.
Look, I agree. And sometimes you get bitten badly, like we were in 2022.
I guess my impression is that that's not the board's role. Your role is to keep the retirement plan sound for our current retirees today and future retirees. The county executive and county council is their role to decide if funding is available and if it's affordable. I don't see that as the board's responsibility at all.
I think it's our fiduciary responsibility to not make decisions on 6 months of data. I made the exception in 2022. It turned out to be the wrong decision.
That should be one of your criteria. Use that as criteria today.
Any other questions? Comments?
I'm not, the money thing is not really my thing, but the one thing I wanted to ask was one of the things when I did all the research on the public pensions in the state of Missouri, at least where does the ordinance stand? At least that there would be a review on a yearly basis, which has not been the case with this pension board.
Excuse me, a review of our plan versus what?
No, just a review of a COLA. In other words, no one knew about a COLA. The last one was 2005. Then I started speaking with the council and started, looking and researching all the public pensions from the state of Missouri.
Yeah.
And all of them there will be a review, but then there were other things. It had to be a certain funding or whatever, but they would look at it on a yearly basis.
Yes,
And where are we with that ordinance?
it's not an ordinance. That's a policy. Well, we haven't committed it to an ordinance, but that is the policy. That's what we just went through.
Okay, so
That is our policy per se. That's what we
to
just
do a
went through.
review on a yearly. basis?
Annual basis, which is what I committed to you some time ago. Yeah. We're not, at this point, I wouldn't even try to make that into an ordinance. I don't think that's. They may have other things more important to consider at this point. But it doesn't have to be. I think that is probably best left up to the board.
But
As
but
to
it
what
went
might
from
be.
2005 to 2000. It went from 2005 where there was a COLA to what, 2000, 2022, like. It was a long time.
I understand 2021 for 2022. I understand. I would. It strikes me as not being appropriate to put that in the ordinance, in the form of an ordinance, but to leave that as a written policy of the board, that the board can,
Just to do the yearly review. Okay.
yeah.
She was asking about the update of the ordinance that had gone on. And whenever that was done by the board and review, a vote was taken and about.
Was that actually in there?
Yes, sir.
Maggie put that in there?
Yes, sir,
Okay, well, that is sitting wherever it is.
with the county,
Okay.
Okay.
but that's what she was referring to.
Matter of fact, if I had to go over that again, and I was one of the authors of that, I suppose, I would not have that in the ordinance, but I think it's something that's done in any event, and it's something that should be on the board's policies.
At least to review it on a yearly basis. Is it feasible or isn't it monetarily feasible?
We voted to.
That is our policy. Matter of fact, I think it should be, let me just leave it there. That is our policy in any event. That was done either officially or, formally or informally in any event. And we haven't been at near 80% for quite some time. We look at this every year, as you know. We look at this each and every year. And that's why Paul's report is so important. But let's leave that as written policy so the future board members can always look back at that. All right, anything further? No? All right, our next meeting is in July. That's July the what?
August.
Excuse me, August, excuse me.
Okay.
Retrograding here, 20, okay.
Move to adjourn.
See you all then. Let us know, since this is vacation period, please let us know as soon as possible if you plan to attend that meeting, given your personal schedules, or not just because it's vacation period.
But I think I'll be here those days. I'll let you know.
We have a motion to adjourn.
Second.
Do we have a second? Thank you.
Second.
All those in favor of adjournment?
Aye.
All those want to oppose and possibly lose their job as a board member? Start with $100 a month.